Welcome to our channel, where we explore the world of personal finance and help you make smart investment decisions. In today's video, we'll be discussing the top 3 investment mistakes to avoid, whether you're just starting on your investment journey or you've been at it for a while. It's important to avoid these common pitfalls. Mistake number 1. Not having a plan. One of the biggest mistakes you can make when it comes to investing is not having a clear plan in place. This means setting goals for your investments, determining your risk tolerance, and creating a diversified portfolio. Without a plan, you'll be more likely to make impulsive decisions that may not align with your long-term goals. Not having a plan in investing can lead to a number of negative consequences. Without a clear goal or strategy in place, you may end up making impulsive or uninformed decisions that do not align with your long-term financial objectives. This can result in lost opportunities or poor investment returns, which can negatively impact your financial stability and security. Not having a plan can also make it difficult to track your progress and measure the success of your investments, which can make it harder to make informed decisions about your portfolio. Additionally, investing without a plan can lead to feelings of anxiety or uncertainty, which can lead to poor decision-making and potentially even financial ruin. Overall, it is important to take the time to develop a well-thought-out plan before investing in order to set yourself up for success and maximize your potential returns. Mistake number 2. Being too conservative or too aggressive. Another common mistake is being too conservative or too aggressive with your investments. It's important to find a balance between the two and create a portfolio that aligns with your risk tolerance. If you're too conservative, you may miss out on potential growth opportunities. On the other hand, if you're too aggressive, you risk losing money in the short term. Being too conservative or too aggressive in investing can have significant consequences on your financial portfolio. Being too conservative means that you may not be taking full advantage of potential growth opportunities and may not be able to achieve the returns you desire. On the other hand, being too aggressive can lead to higher levels of risk and the possibility of significant losses. It is important to find a balance between these two approaches and to consider your personal financial goals and risk tolerance when making investment decisions. A financial advisor or professional can help you assess your risk profile and recommend a portfolio that is appropriate for your needs. It is also important to regularly review and adjust your investments as your financial situation and goals change over time. Mistake number 3. Not keeping an eye on your investments. Finally, one of the biggest mistakes you can make is not keeping an eye on your investments. It's important to regularly review your portfolio and make sure it's still aligned with your goals and risk tolerance. Don't be afraid to make changes if needed, but be sure to do so thoughtfully and strategically. Not keeping an eye on your investments can have serious consequences for your financial well-being. When you invest your money, you are putting it at risk in the hopes of earning a return, and it is important to regularly monitor your investments to ensure that they are performing as expected. Failing to do so can result in missed opportunities to sell or rebalance your portfolio, as well as leaving you vulnerable to fraud or mismanagement. Ignoring your investments can also make it difficult to track your progress towards your financial goals and may lead to you making decisions that are not in your best interests. It is essential to stay informed about the market and your investments and to make changes as needed to protect and grow your wealth. Mistake number 4. Not diversifying your portfolio can be a risky investment strategy as it puts all of your eggs in one basket. By investing only in a single asset or a small group of assets, you are exposing yourself to higher levels of risk, as any downturn in that particular asset could have a significant impact on your overall portfolio value. In contrast, diversifying your portfolio by investing in a variety of assets such as stocks, bonds, real estate, and cash can help to spread the risk and potentially reduce the impact of any individual asset's performance on your portfolio. It is important to note that diversification does not guarantee a profit or protect against loss, but it can help to mitigate risks and potentially increase the chances of achieving your investment goals. It is always recommended to consult with a financial advisor or do thorough research before making investment decisions. Mistake number 5. Chasing after high-risk, high-reward investments. While it might be tempting to try to make a quick buck with high-risk investments, they can also be very volatile and carry a high likelihood of failure. Instead, focus on investments with a more consistent track record of steady returns. Mistake number 6. Ignoring fees and taxes. It's important to carefully consider the fees and taxes associated with your investments, as they can significantly impact your overall returns. Look for low-cost options and be sure to factor in taxes when planning your investment strategy. Mistake number 7. Not regularly reviewing your investments. Not regularly reviewing your investments can have serious consequences for your financial well-being. By not keeping track of your investments, you may not be aware of changes in market conditions or the performance of your investments, which could lead to significant losses. Additionally, you may be missing out on opportunities to rebalance your portfolio and ensure that it remains in line with your financial goals and risk tolerance. Not reviewing your investments can also make it difficult to track your progress towards achieving your financial goals, such as saving for retirement or building wealth. It is important to regularly review your investments and make any necessary changes to ensure that they are aligned with your financial objectives and that you are maximizing your potential returns. This can involve seeking the guidance of a financial advisor, staying up to date on market news, and monitoring your portfolio regularly. Mistake number 8. Being too cautious. While it's important to be careful with your money, it's also important to take calculated risk to potentially achieve higher returns. This might mean investing in riskier assets like stocks or venture capital, or trying out new investment strategies. Mistake number 9. Following the crowd. Following the crowd while investing can be tempting, especially when you see others making significant profits from a particular investment. However, it is important to remember that following the crowd can also be risky and may not always lead to the best financial outcomes. It is essential to do your own research and make informed decisions based on your own financial goals and risk tolerance. Just because an investment is popular or trendy does not necessarily mean it is the right choice for you. In fact, following the crowd can lead to overvaluation and market bubbles, which can result in significant losses for investors. It is always a good idea to diversify your investments and consider a range of options, rather than putting all your eggs in one basket. Ultimately, it is important to make investment decisions based on your own financial situation and goals, rather than blindly following the crowd. By avoiding these common mistakes, you'll be well on your way to making smart and successful investments. Remember to have a plan, find the right balance between conservatism and aggressiveness, and keep an eye on your investments. By following these tips, you'll be able to maximize your returns and reach your financial goals.